In a recent interview, the Salesforce CEO Mark Benioff took a slight shot at Palantir, saying that he wishes he could get the kind of prices that Palantir charges their customers, hinting at how expensive Palantir services are. And also hinting at he would be envious, or he is envious, of the valuations of Palantir stock trading at the multiples of its valuation on earnings or cash flow or sales. Whatever way you look at Palantir's valuation, it's extremely rich. And I'll share with you in this video just how rich it is compared to Salesforce. But after seeing those comments and seeing the details of that interview, I thought it'd be an interesting comparison to compare Palantir and Salesforce stock and answer which one I think makes the better buy at current market prices. So let's compare these two companies on longer-term trends in revenue, in cash flow, in returns and invested capital, and then look at valuation to see just how different the valuation is between Palantir and Salesforce and see which one I think makes a better buy. Let's jump right into it after a brief message from my sponsor.
I want to thank The Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
So I went back to 2018 to get data on revenue growth for Palantir and Salesforce. Salesforce has generated solid growth, increasing from $13.3 billion, more than tripling, to $39.5 billion in the most recent trailing 12-month period. That's good for a compounded annual growth rate of 18.3%. Of course, this includes a few acquisitions in there, but still solid growth of 18%, over 18% in that time. But Palantir has done even better than that, increasing its revenue from $600 million up to $3.4 billion, good for compounded annual growth of 31%. And Palantir's revenue growth is accelerating while Salesforce's revenue growth is decelerating in recent quarters. So revenue growth certainly goes to Palantir in terms of the advantage, and in terms of the looking ahead revenue growth expectations, I expect Palantir will continue outgrowing Salesforce, probably by a margin greater than 2-1 over these next few quarters, perhaps even over these next few years. The next thing I wanted to compare these two on is their operating cash flow to sales ratios. I want to see how much of every dollar in sales turns into operating cash flow for these two companies. And Palantir has done a phenomenal job of improving this metric. The company's OCF to sales ratio has improved from negative 27% at its lowest up to 50% in the most recent trailing 12-month period. This is among the highest of any of the companies that I'm following, among the highest. So you're not going to see very many companies that have an operating cash flow to sales ratio above 50%. Palantir has done a phenomenal job in this regard, in both accelerating revenue growth and delivering expanding profit margins. You can start to understand why Palantir stock has been soaring in recent quarters. Salesforce isn't doing bad in this regard either. Its OCF to sales ratio has improved from 25.6% to 33 1/3, and that's also a solid ratio. Many companies would be envious of this ratio, but since you're comparing it to Palantir, which is one of the best, it makes Salesforce look like an underperformer, which it's not. It has a good number in terms of OCF to sales. The next metric I wanted to compare these two on is the return on invested capital. This measures how good a management team is at taking investor capital, turning it into products and services that generate profits and cash flow. Now, before you say these companies are not going to investors and asking for money, that might be true, but they're still using investor money. And I'll tell you how. When a company generates profits, let's say they generate $100 million in profits, if they don't give you $100 million in dividends, that means they're keeping some of your money. Investors are entitled to the profits of a company. And if a company doesn't pay dividends at 100% of its profit, then it's keeping some of that profit for reinvestment using internally generated fund for reinvestment. It's the most common way management teams use investor capital because it doesn't require making a new share sale and risking the negative sentiments when you announce a share sale or going out to the bond market and trying to borrow money. The most common way management teams use investor funds is by keeping profits, keeping cash flow, reinvesting it in the company rather than returning it to investors as a dividend. So in this regard, Palantir, again, has done an excellent job with an ROIC of almost 50%, improving from negative 130%. The trend is much better than Salesforce. The number is also much better than Salesforce, almost 7x the level of Salesforce. Now, Salesforce is also doing a great job here, more than 7x improving from 1.3% in 2020 to 7.8% in the most recent trailing 12-month period. However, an ROIC of 7.8% is not even above Salesforce's estimated WACC, weighted average cost of capital, which is likely above 10%, probably closer to 11 or 12%. So even though they're improving, the number itself is not that great for Salesforce. All right, so now that we looked at the performance differences and we saw clearly Palantir beat Salesforce on revenue growth, on cash flow, on ROIC, going into the valuation comparison, you would expect Palantir to be selling at a more expensive valuation than Salesforce. It's just a better company with better performance. And it is indeed selling at a more expensive valuation, more than 10 times that of Salesforce when you measure on a forward price to OCF ratio. Palantir is trading at a forward price to OCF, which is operating cash flow, at 189, more than 10 times that of Salesforce at a price to OCF of 14.9. Now, I do strongly believe that Palantir deserves a premium valuation. In fact, if these two were trading at the same price, it would be Palantir as the better investment, no brainer, no second thought needed. But Palantir is trading at more than 10 times the valuation of Salesforce, and I think that valuation premium is too much. So if I had to pick between these two companies right now, today, at current market prices and these valuation differences, I would pick Salesforce. But completely acknowledging that Palantir is the better performing company, Palantir is the company that I would rather want to own as an investor if they were selling at the same price, but they're not. They're not selling at the same price. And so considering my risk versus reward and the potential for long-term improvement in shareholder gains, I would rather buy Salesforce at these lower valuations than Palantir at the nosebleed valuations, even though Palantir is an incredible company, as I just demonstrated here. I'm curious to hear what you would think. Would you rather pay the higher price for Palantir stock and get the better business? Or would you rather get the discount and buy Salesforce stock at the significantly lower valuation? Let me know in the comment section. I'm curious to read them. Hey everyone, so many of you have been asking about my investing strategy, and I'm excited to announce that I've written a book that's available for sale now that describes my 6-step investing framework for evaluating stocks. I've added the link in the description below.